What is up, guys? In today's video, we are going to explain an RRSP. This hopefully should contain everything you need to know about this account. It's a really good tax advantageous account we have here in Canada. So we have a lot to get through today, so let's just get right into the video. So I guess let's start with just the basics of this account. I'll assume that you know nothing about it, so if you know some things about it, I apologize. But let's start with the basics. So RRSP stands for Registered Retirement Savings Plan. And I know when you hear that savings plan, there's kind of a common misconception here at this account where people think that this is actually like a bank account or maybe like a high interest savings account. That's not the case at all. An RRSP is simply a vehicle. Now you can choose to put any number of different investment, granted that they qualify, into this vehicle. So it doesn't have to be a savings account. It could be mutual funds, it could be private equity funds, it could be just a high interest savings account, but obviously you want to be making more than that. So it's a number of different investments that you can actually put into this vehicle. It's not just a savings account. So how this account works is you essentially can contribute, and I'll talk about the limits of how much you contribute later in this video, but when you contribute into this account, you get a corresponding deduction that you use to offset your income. Now, I don't want to get too complicated here, but if you are curious about taxation in Canada, I made another video about that and I'll put that there so you can get the basics of that. But essentially, if you're an employee here in Canada, chances are they're doing what's known as source deductions, and all source deduction means is that the CRA has taken an estimated guess at what you would be paying in taxes for the year, and that's coming right off your paycheck. So when you look at your paycheck, you probably see that you have gross income and then you have net income because they take off CPP, EI, and the biggest one, which is taxes. And all that is an estimation of how much taxes you'll need to pay at the end of the year. And then when you actually do your taxes, you verify that that's actually how much it is. When you contribute to an RRSP, you get to use that and deduct that off your income. So hypothetically, if you made $80,000 at a job in a salaried income for the year, and they would be taking source deductions off that, and you put, let's say, $10,000 into an RRSP in that year, well, when you go to do your taxes the following year, you would be able to say, hey, wait a second, I put $10,000 into an RRSP, and that gets deducted off your income. So it'll go from $80,000 to $70,000, meaning if they were taking taxes off your paycheck each month, you would get a pretty nice tax return. So when you have money in this RRSP account, and you can, like I mentioned, invest it into a number of different things. It's not tied to a savings account or any type of investment. You put it in mutual funds or private equity or whatever you want. Any returns that you get within that account are actually tax deferred until you withdraw it. And now where this becomes very powerful is, let's say you had a non-registered account. What non-registered means is you just have these investments personally. They're not in any tax sheltered account. Well, every year, if you made any type of return, whether that be from interest or capital gains or dividends, those returns would be taxed. And depending on what your marginal tax rate is, it could be very little tax or it could be quite a lot of tax. So at the end of the day, you have little left over to put back into the investment to let that compound over time. But in an RRSP, it's all tax deferred, meaning that at the end of the year, when all your returns come in, you don't have to pay taxes on them, and that gets reinvested back into the investment, and it grows and compounds at a much faster rate than other investments where you have to pay tax on it. Now, the idea of this is that during your high income producing years, such as maybe 25 to, let's say, 60, you're going to be making a high income and you want to offset some of those high taxes that you're paying. And you can do that by putting money into an RRSP. And then all of that growth is tax deferred. And the idea is then when you withdraw it in your later years and you're not earning such a high income because you probably stopped working now and you're ready to retire, that's when you'll be paying taxes on everything that you withdraw from the account. But hopefully at that point, you'll have stopped working and you won't be in such a high income tax bracket, and you'll be able to pull these at a relatively low tax rate. However, your money's not locked into an RRSP. If you contribute to your RRSP and let's say 5 years down the road, you need to take that money out, you can take it out. It's not locked in or anything like that. There are some things that you need to know though. One, withdrawals in that year are going to be taxable. And where this can become a problem is, let's say you're making that $80,000 and you want to take $30,000 out of your RRSP. Well, if you watch my tax video, and I linked that earlier, you'll know that now we're going to get bumped up to a higher tax bracket, and and that 30,000 that we want to take out of our RRSP is going to be taxed at a high rate. That's the first problem. The second problem is, and this is a little bit where you need to be careful, is that the contribution room is now gone. So, and I'm going to talk about contribution limits later, but when you withdraw money from your RRSP, that contribution room that you initially had to put that money in is now gone forever. So you want to try and avoid pulling your RRSPs before retirement because it's not a good thing. It doesn't make too much sense. Only do it in specific situations where you really need to. And later in this video, I'm actually going to tell you about 2 ways that you can do it without consequences. So stick around for that. But in general sense, you don't want to be pulling your RRSPs if you don't have to. So only contribute what you know you can allocate towards investments and don't extend yourself putting too much into it. Now, this is how it works upon retirement. You can contribute into an RRSP until December 31st of your 71st birthday, so 71 years old. At this point, you have 3 options for your RRSP. The first option, which is a terrible option, and I do not recommend it, and only in a very specific circumstances would I recommend it, is you cash it all out. So what that means is you essentially take everything out of your RRSP. If you only have a little bit in it, maybe let's say 20,000 or 30,000, it might not be the biggest deal. However, if you have a significant amount, let's say $200,000, $300,000, $500,000 in it, that is going to be 100% taxable. And basically after $250,000, you're in the highest marginal tax bracket, regardless of what province you are in. So it's going to be taxed probably close to 50%. And that's a very high tax bracket. You don't want to do that. That's a bad idea. The other 2 options that are much more suitable is you can convert it into a RIF. Now, we love our acronyms here in Canada. All RIF stands for is Registered Retirement Income Fund, and the characteristics of this are actually very similar to an RRSP. The only difference is you cannot contribute to a RIF. Essentially, once you convert it into a RIF, it's just locked in. There's no contributions that are made. However, it's still very similar. All the returns are still tax-free, so you can continue to still be invested within the market in a RIF with whatever investment that you've chosen. So all returns are still tax-free. All withdrawals are going to be taxable in that year, so just the same as an RRSP. The main difference with a RIF to an RRSP is now you have minimum scheduled withdrawals. The CRA is going to want to see a minimum amount withdrawn each year. And this is essentially for them to put a time frame on collapsing this account, and the CRA and the government wants their taxes back because they knew that you had these tax deductions and you grew it tax deferred. So now they're saying, okay, let's start to pull this money out so we can get our taxes back. We've given you a break, now we want ours. So the percentage changes year to year. It depends on a number of different factors, but on average at 71 years old, it's going to be 5% per year. And then later on, 20, 30 years down the road, it's gonna go as high as 20%. So they're really going to be putting an emphasis on you wanting to take out all of this money out of your RIF during your retirement years. Now, there are minimum withdrawals from this, but there's no maximum withdrawals. So hypothetically, if you wanted to burn through this RIF in, let's say, 5 years and withdraw everything, 200 grand a year, if you wanted to, you could do that. There's no maximum withdrawals, but there is a minimum withdrawal. Now, the benefit with a RIF, there is more flexibility within it. You can still choose your investments, so you can maybe still be in a high equity position. You can invest in fixed income. You can be a little bit safer. You can be a little bit more aggressive. The choice is up to you, and you have more flexibility in how you take that. So you have the minimum, of course, but you have no maximum, and you can take as much as you want. The third option that you can do at 71 to convert your RSP is you can convert it into an annuity. And I won't get too much into annuities. They are kind of a complicated product, but in the easiest way to understand it, an annuity is essentially an insurance contract where you give an insurance company a lump sum and they agree to then pay you a fixed amount for a certain number of years. So it could be something as simple as saying, hey, if I give you $100,000, will you pay me $10,000 a year for 15 years? And now, of course, they're basing this off the fact that they're gonna take that $100,000 and they're gonna invest it, and they're going to be able to use that money. And of course, some contracts have it where the guarantee is based upon if you die, you do not get the leftover cash. And so they're basing on a little bit of a mortality rate here where they won't have to pay out all these annuities, and so they can put that buffer in their contract. So they say, sure, absolutely. You give me 100 grand, I'll give you 10 grand a year for 15 or 20 years, let's say. And they know some people are gonna die, some people won't die, but they can invest the cash and they have those rates figured out. Now, the benefits of an annuity, it's still gonna be taxable upon withdrawal, but there's no need to manage anything now. So this is really a much more guaranteed option. If you're just worried about outliving your money and you're worried about market conditions and you're worried about the stock market going up, down, left, right, and not being able to earn enough, and you say, you know what, I know exactly what I need 40 grand a year. If I can get an annuity for 40 grand a year for 20 years, I'm good to go. I don't wanna worry about it. I don't wanna think about it. Just set it up. It's just set and done. It's very easy, very simple. It's guaranteed. Also, another benefit with annuity is there's no minimums each year. So if you wanted to pull out a very small amount, you could do that. Like I mentioned, a RIF does have that minimum. Annuities don't have a minimum. So this is just really right for those people who want to guarantee. They don't want to think about it. They're worried about market conditions, but there's zero flexibility with this type of account. It's set and done. And if you wanted to maybe make more, nope, that's not going to happen. It's very rigid, but it has guarantees. By the way, before I go on, I want to quickly tell you guys about Affinity Life. So Affinity Life is an online life insurance platform here in Canada where you can actually view quotes 100% online without having to put in your email or anything like that. And you actually have the ability to apply 100% online. So you don't have to do a long paper application. You don't have to have an agent over to your house to do the application. You can just do it from the comfort of your own home on a laptop or a computer or your mobile phone. And it's all done 100% online. So yeah, I'll put the link in the description below and you can check that out. Okay, let's talk about withdrawing your RRSPs now. I mentioned that there's a few different ways that you can actually withdraw it without any consequences. So the first way that you can withdraw it is actually doing something known as the home buyer's plan. So the home buyer's plan is essentially a way in which you can use your RRSP to fund the down payment of either a home that's already built or you can build a home. And there are a few qualifying criteria. So I'll put the link, there's actually a canada.ca link and I'll put it there where all the criteria for this program exists and I'll put it in the description below. But in a nutshell, basically how it works, if you want to buy a home or build a home, you can borrow up to $35,000 for yourself or for a related person with a disability to get this home. So you can get this for the down payment and borrow it tax-free. So there's no taxes upon withdrawing it. It doesn't affect your contribution room. You're just taking it out of the account and you use it for the down payment or for the purchase of the home. Now, it does need to be repaid, but they actually give you up to 15 years to repay it. So there's quite a big window in there for you to get this repaid and back into the RSP. And by the way, if you're thinking about buying a home and you don't have anything in RSP, you can actually do this program and put money into an RSP and then eventually use it for this program. You only need to keep it in the account for 90 days. So where this could be a really big benefit is, let's say that you're buying a house and you have $30,000 saved up and you're going to buy it and you don't have anything in the RSP, and maybe in this year you have a salary of, let's say, $80,000. Well, you can contribute this $30,000 into an RSP. You're gonna get the corresponding tax deduction, so you get to write off $30,000 on your salary, so you get a big tax return. Keep it in the account for 90 days, and then after that 90th day, you can then take it out, use it to purchase the home, so you get a big tax deduction in this year, which is good, and you'll have 15 years to repay this back into the RSP, and you're gonna buy the house anyway, so it's a win-win. The second way that you can get money out of an RRSP tax-free and without any contribution room problems is what's known as the lifelong learning plan. So the lifelong learning plan is essentially going back to school for some type of full-time schooling. That could be university, could be other programs. Again, there is a canada.ca link with more of this eligibility criteria, and I'll put that in the link description below. But essentially, you can borrow up to $10,000 per year to a maximum aggregate amount of $20,000. So let's say you're borrowing $5,000 per year, well, you have 4 years. If you're borrowing $10,000 at a maximum, you have 2 years. But you can borrow this money and essentially use it for different schooling purposes. Now, the repayment period with this is 10 years. So it is a little bit less, but it's still a great program. You can take money out of your RRSP, use it for schooling, repay it. You have a 10-year repayment period, so it's not that bad, and be on your way. Now, the last thing that I'm gonna talk about is contribution limits and deduction limits and some penalties if you over-contribute, and then we'll wrap this video up. So the contribution limit is based upon your salaried income. So there's a little bit of equation here that I'll give you, and stay with me. It's 18% of your income, or there's a max amount. And now this max amount is indexed. And what that means, it essentially goes up year over year over year. So we started in, I think, 1985, and it was like 10,000. Now in 2022, that max is 29,210, and it's gonna keep going up. And what that means, let me give you an example here. If you make $100,000 in a year as a salaried income, 18% of that is going to be $18,000. So it's gonna be either the lesser of 18% or this max of 29,210. Well, 18,000 is definitely less than 29,000. So that is going to be your contribution room. And now this contribution room adds up. So if you've been working for the past 5 or 10 years, any amount of salaried income that you've been making at 18% or this maximum has been accruing in this account. And so you might have a limit of 50, 60, 70,000, $100,000. It just keeps growing every single year, assuming that you're not contributing to it. And now this information, in case you're wondering where to find it, can be found in 2 different places. The first one is on your notice of assessment. You get that from the CRA and you'll see a little line that says RRSP contribution room or contribution limit. The second place you can find it is actually on the CRA website. So if you create a CRA My Account and you need to sign up for this, if you don't have one, it's really good to have. It has all your tax information on there. You can connect it with tax software and do your taxes online. It's a super good resource. I think you just need to sign up for it and they send you a letter and you have a code and you put the code in. It's a good account. But if you have one, just log into your account and you'll be able to find that RRSP contribution limit. Now, one thing you want to be careful of is not over contributing in an account. So let me give you a hypothetical example. Let's say that you have $20,000 of contribution room and you contribute $25,000 to it. Well, there's going to be a problem there. This is how it works. The CRA actually gives a little bit of leeway, and that leeway is $2,000. So if you go slightly over up to that $2,000 amount, they'll say, fine, it's okay. It's not meant to abuse that. That's just meant as a safeguard to try and protect you. However, anything that you go over that $2,000 is now going to be charged a penalty of 1% per month, which equates to 12% per year, which is a lot. Also, I should say anything over the limit, not even the 2,000, but the original limit is not deductible against your income. So not only do you not want to go over, you don't want the penalty, you want to be careful to make sure you don't go over. This is your responsibility as well as your financial advisor's responsibility to make sure that you don't go over. One more thing to note, if you do have a pension or a group RRSP at your employer, okay, at your work, this will correspondingly reduce your RRSP room. So you can't have your own personal RRSP and a pension or an employer RRSP and be contributing to both of them and have the same limit for both. They're gonna get added together, so just keep that in mind. The last thing that I'll talk about is something known as a deduction limit. A deduction limit is a little bit different than a contribution limit, and it's quite misleading because it shouldn't be called deduction limit. It should be called maybe deduction balance, because that's a little bit more understandable for consumers. Now, what that means is in any given year, when you contribute to an RRSP, you need to actually elect to deduct it against your income. It doesn't happen automatically. One of the things that you can do is you can elect to deduct a certain amount in one year and save more for the next year. Now, why would this happen? Well, let's say you got a sudden inheritance from your grandma or something like that. And let's say it's $100,000 and you thought, you know what? I'm gonna put this all into my RRSP, and let's say you have the limit for it and you put it all in. Well, at this point, maybe you only made $80,000 in that year and you don't need to deduct $80,000 all at once because we know we have a progressive tax system in Canada. So the more that you deduct down to zero, it's not gonna be as beneficial because the taxes that you save are gonna be much less had it not been a higher amount, such as maybe 80,000 to 40,000. 80,000 to 40,000, you'll save more. 40,000 to zero, you'll save very little taxes. So you say, I don't wanna use it all in this year. I'm gonna use 50,000 this year and 50,000 next year. Well, in that case, what will happen is on your notice of assessment and in your CRA My Account, you'll see this limit. You will have then a $50,000 deduction limit. And like I mentioned, it's a little bit misleading because it should be called deduction balance, meaning that you have an additional $50,000 to write off against your income in the next year or the year after. However, your money is still invested within whatever you chose in your RRSP. I think that's everything that I can say about an RRSP, and I think I've actually covered quite everything that you could say about an RRSP. If you guys have any questions, please just drop them in the comments below and I'll reply to them. And if you guys are enjoying this content, all I ask is that you give it a thumbs up, and I'll see you guys in the next video.